So hello, my name is Chris Newlands. I'm the editor of FTFM. And for the next 45 minutes, we'll be looking at perhaps the aptly titled panel discussion, The Descent of Active Fund Management. The active fund management market has taken quite a beating over the past 12 months, with very big questions being asked about pay, performance, and fees. In fact, some of the most difficult questions have been posed by Professor Kay himself, who joins us on this session. He has been very critical of the fund management market, to say the least, and he is accompanied on the panel by four very brave souls from the fund industry. We have Roger Yates, the former CEO of Henderson and Pioneer, Richard Buxton, head of UK equities at Schroders, Hamish Mayer, head of private equity funds at F&C, and Mark Dampier, head of research at Hargreaves Lansdowne. Together, we'll take a look at what exactly the future holds for the active fund management market. John, perhaps I can start with you. Does the active market have any value, in your opinion?
Of course it does. It has huge value. I mean, it's only the active market that can provide the kinds of intermediation we want and the requirements of effective financial intermediation, which are most of all enabling savers to place their funds with confidence because there is a process which generates the information and the monitoring which is needed to enable money to be successfully invested in ongoing and developing business. The problem we have at the moment is that we have a great deal of so-called active fund management which basically doesn't do these things. It doesn't do these things partly because a great deal of it is closet indexed, the active share of ostensibly actively managed funds is often very low, and that's an inevitable product of a world in which asset managers are governed by a tyranny of relative performance benchmarks. And it's one in which the demand on them to generate alpha over relatively short periods of time creates a world in which they devote a lot more time to thinking about the changing expectations of other market participants than they do to thinking about and understanding the underlying competitive strengths of the companies in which they invest. So it's not that we don't need active management. We need more active management, but we need more active management of the right kind.
Perhaps one of you guys could step in.
Yeah, I agree with that. I think it's an incredibly challenging commentary by the professor, and I've been a poacher and a gamekeeper in this industry, and when I was CEO of a listed asset manager, having been pretty proud of my profession over the years, turning up and talking about your business to a range of fund managers, and I should say present company accepted here, but in general, I would say I found the quality of questioning from fund managers lamentable. Fund management is a pretty simple business. You know, you've got flows, you've got markets, you've got costs, and you've got investment performance. That's sort of it. So you would think the degree of questioning will be pretty sophisticated around those things. But with some honourable exceptions, it was pretty hopeless. On the one hand, that gave me enormous optimism that you could distinguish and differentiate yourself by doing the job properly, and I hope that's still true today. It also, in the context of private equity, is an extraordinary contrast with the degree of knowledge and immersion that the best private equity managers have in the businesses they invest in, relative to the thin layer of knowledge that, in my opinion, most fund managers have of the businesses in which they invest.
Anyone else would like to add?
Perhaps I could comment just briefly as the token private equity representative on the panel here, and one that has that started his career in the public market. So I actually can see the difference between the engagement and the knowledge that a public equities fund manager or analyst has with a public company and a private equity fund manager has with private companies. And I think actually Professor Kay did allude to this. I was getting quite worried, but towards the end of his talk it became clear that a number of the wholesome activities that he supports are actually very well represented in the private equity space. You know, understanding businesses, engaging with management, working with them to grow profits. I mean, I think we had a slide earlier today showing that something like 2/3 of growth in value has been through improving profits. And that doesn't just happen by accident. People in private equity do understand the companies, they do spend a lot of time, they hold the companies for years. So I think private equity perhaps is getting close to Professor Kay's, I was going to say utopia, but his desired promised land. I think we might be travelling, this sector might be allowing us to travel towards that.
Mark, do you have anything to add? Or?
Well, I come from a completely different side, of course, being on the retail side, and the descent of fund management is an interesting one. I actually wouldn't entirely agree with that. I'm an active supporter, but there aren't many good active fund managers. That's the reality. In my field of, say, 2,500 unit trusts, I could probably get it down to, or have got it down to less than 5%. And that's the truth of the matter. And in fact, listening to Professor Kay, I'd also go and say that most of those managers are what I would call long-term managers, i.e. they're looking out at well over 5 years or 10 years. In fact, one well-known fund manager actually rather had a go at most of the private equity people by saying, well, they don't look more than about 5 or 6. I've got some private equity in mine, and I'm looking at 15 plus. But I'd also have to say that from a retail aspect, we are also under great pressure from retail clients all the time. And the amount of conversations I have with retail clients about short-termism is absolutely amazing, not helped by the media, who continually look at short-term performances, by which could be 6 months, a year, or 3 years, which I think is absurdly short as well. But that's the sort of pressure we're under, and clients expect me just to pick the winner. And for those who've seen the Japanese market, there's a well-known fund that's either top or bottom, and supposedly I was supposed to be able to pick the bottom of this fund and get everyone out at the top. Well, actually, everyone's got in at the top, and now they're down about 25%. Those in the know will know the fund I'm talking about, but that's the sort of pressure we're under as a retail operation as well. And if we don't get it right, we're continually pecked at by the journalists as well, actually, I have to say. So there's a lot of pressure all round.
Richard, do you feel under pressure?
Yeah, conscious we've probably got a lot to talk about, and we can't all answer every question, but I'd like to think that we do represent precisely the sort of long-term investor that Professor John was talking about. You know, we do have a genuinely 5-year plus time horizon. If I buy or sell, 2 to 3 companies a year in their entirety in my portfolio, that's kind of, I have to go and lie down. That's exactly the thing. But having a high active share, as recommended in the K review, of course, if everyone were to go to that model, the money would clearly gravitate to those people who are capable to, let's call it that 5%, or be generous 10%. And the scale of money that would flow in that direction would quickly dwarf your ability to actually identify and benefit from those positions. So there is an element to which the active manager does need a lot of bad active managers out there in order to just generate returns.
Seems to be a lot of bad ones. Are we pushing more towards too many bad fund managers?
I mean, there are far too many funds, but ever since I started in this game 27 years ago, we have talked about consolidation in the industry, wiping out, the poor performers, the quasi-index active funds, etc. But because it's a low capital intensity business, no one ever really pulls out. So, we're still debating this 27 years on.
There's also a heck of a lot of very sticky money that doesn't seem to move out, even of very, very poor performing funds. So in a way, that's a major problem. I mean, when I first came into the industry, I don't think there were more than 300 funds, and now there's over 2,500.
There's a problem with governance with mutual funds. So, you know, if there's an underperforming mutual fund in the UK, the only real pressure, besides commercial pressure, for the manager to do something about it is their own. So compare that to investment companies or investment trusts that have external governance. I mean, isn't it amazing that in this day and age you've got 2,500 funds with billions, probably trillions of assets that have effectively no governance around them?
Yeah, you could argue that's a fault of that open-ended type of fund. But I expect there's quite a few people in investment trusts that are underperforming as well. So it's not entirely, you can't entirely have it your own way. I think it's a cause of the last 20 years of a lot of direct sales where people have been sold funds and where the people actually don't even know what they've got. And there's funds there with billions of pounds in which have been underperforming not for 2 or 3 years, but I'm talking 10 years plus, which have still got, as I said, £1 billion, £2 billion in, and the money's still there. And that's despite newspapers perhaps arguing that, you know, the money should come out. But the very people who've had those funds don't read newspapers. And that's the problem. It's trying to get to the target audience.
At the risk of picking up on a sensitive issue, I've asked myself, why is it that fund management fees are characteristically so high? And I think the basic explanation is that this is a market that has two characteristics. One is it is really rather hard to judge performance. As I say, recent performance gives you very little information about the long-term capabilities of a manager. And has been noted, there are relatively few managers who bring genuine skill to this game. So it's quite difficult to say who is good or who is bad. But it's well worth paying quite a bit more to someone who is actually good. If you're a market that is like that, the result is that price competition is not a terribly effective weapon, as a rule. You know, you don't succeed very well as a doctor by saying, I'm no better than any other doctor, but I'm cheap. Even though that is in truth the reality for the vast majority of doctors, as it is true for the vast majority of fund managers. But the result of that is firstly that fees are rather high, and then secondly that entry is attracted. People proliferate funds, you know, as a means of essentially attracting a share of this of this pot. It's rather like estate agents or a similar market where fees are rather high and there are rather too many of them because it's an easy business to enter.
I think the general sort of idea that fund management fees are too high, I'm not sure actually if you look at it over the long term. I think certain segments fees have gone down a lot. Other segments the fees are much the same. So I'm not entirely convinced that we're necessarily fees are too high. We have also seen trends where there's been a bit of a tendency to try and reduce management fees, basic management fees, and push it towards performance fees, but then that goes in cycles, and we now hear people talking about performance fees as a bad thing. And shouldn't we just have, flat fees? But you can't have both. You can't have very low flat fees and no performance fees, unless you want a sort of under-resourced and probably even more passive industry than we have at present.
I would say that it does amaze me that there isn't more differential in pricing. Clearly, if you've got a great doctor, great surgeon, great heart surgeon, you'd expect to pay considerably more than someone who's fairly average, but people carry on. But to some extent, the money does get centred, and I think one of the problems that Richard's centred on is simply that with only a few good fund managers, the money we're already seeing many funds actually soft close even now because they've actually got too much money going into them, and there isn't enough active managers to go around, in my view. And that remains a real problem for the industry.
I'd make the footnote that not so long ago 2 invitations landed on my desk on the same day. One was to address the Shareholders Association, and the other was to address a conference of fund managers. The Shareholders Association was meeting in Bournemouth, and the fund managers were meeting in Monaco. And, I thought that said a lot. I would pick up the point that Richard has made and that Mark has just, I think, added to, and say that I think the quantity of equity funds that could be effectively, actively managed is much smaller than the quantity of funds which there are. And that's why I think passive management actually has to be a large part of the sector. What I would like to see is a fund management sector in which a large proportion was passively managed. That leads to interesting questions about what exactly we mean by passive management, because I'm not sure passive management involves large stakes in Eastern European mining companies. But that's a separate discussion to have.
One of the things that the more I've A, Schroeder's put a submission into the K Review. B, I was there at the launch of it. We had John into the office afterwards to discuss it. We've sent a memo to our clients, our response to it. And the more I've read it and reread it and thought about and reflected on my own experience, the more I find that I both violently agree with some of John's points and violently disagree with others. There seems there's no middle ground. I either completely agree or I don't. The pursuit of short-termism against long-term, and what a former colleague of mine once described it as the gin rummy approach to portfolio management by corporates in terms of picking up businesses and putting them down and so on. We completely agree that has been not helpful to UK PLC, UK economy, etc. On the other hand, I disagree that the UK stock market has completely ceased to exist as a provider of capital to businesses. There is a cyclical element to this, and the fact that for the last 10 years, a lot of the IPOs have been second-hand vehicles from private equity with too much debt at the wrong price has contributed to this buyer's strike. And at last, it appears that there's beginning to be some meeting in the middle, and the IPO market is beginning to kick off again. But we have had numerous companies that have been able to, in addition necessarily to raising bank debt and so on, other forms of bond and so on, have raised equity capital in order to invest in their businesses. I mean, in the last several months, Drax, the dirtiest coal-fired power station in the UK, has raised equity capital from its shareholders in order to help contribute to converting into a biomass burning the greenest plant in the UK. And we have been able to be there and provide that sort of capital for a business investment, and I think that will continue to be the case. Where you will be pleased to hear is that because the shareholder register is so concentrated amongst a number of long-term investors, people like Neil and myself, that when it came to allocating who was taking up the rights and so on, not only was the company in control, not the investment bank, but they determined what the investment bank's fee was. So, this was an absolute win-win as far as we were concerned, because it's those guys that you want to really squeeze and cut out of the process.
I mean, there's probably some solace to be had that the demise of the UK IPO market, or well, I'm not sure we should use the word demise or whether we're at the bottom of a sort of cyclical low, has in the last decade been replaced by the rise of the UK private equity market. I mean, the UK private equity market is the most developed in Europe by some way, and a lot of the medium-sized companies which 15 years ago would have gone for an IPO are now attracting that finance from the private equity market. And actually they are the engaged and constructive investors that John was yearning for. So in some ways, the loss of the IPO market, it has been, I think, to a large extent compensated for by private equity, which I think is not completely unhealthy.
I think here we're describing two positive groups of development. You know, one in terms of the company that does raise capital for investment, doing so in very clear association with its focused principal shareholders. And the other is, in effect, the blurring of this distinction between, you know, private and public equity. And indeed, the utility sector itself has become an example of that across the board.
Firstly, for John Kay, as Richard here will remember, that companies like GEC and ICI were underinvesting, underperforming companies long before new management came to blow them up. So active management is not just about taking long-term investment decisions. Sometimes long-term investment decisions do not work. It's taking about the right decisions, whether on whatever time scale. And I thought actually Mark gave the best answer in terms of active versus passive. It is very difficult to pick the best fund managers. But as he said, there are a lot of underperforming funds which have been serial underperformers for a long period of time. To justify active fund management, you just have to screen out the losers rather than necessarily pick the winners, and then you will get a universe which, on average, will perform okay. So two separate questions, and perhaps you can separately answer them.
The first one, the history of ICI is an interesting case because ICI made what was probably the best genuinely long-term post-war decision by a large British company post-war, which was the recognition in the 1940s that the future of the chemical industry lay in pharmaceuticals. And the really interesting thing about ICI, the development of ICI's pharmaceutical division, was that that actually lost money for them for nearly 20 years, from the late 40s when they established it to the mid-60s. Eventually then it produced a series of blockbuster drugs and became more valuable in aggregate than the totality of the chemical company. The interesting thing about that story is it is almost impossible to imagine management of a large British public company making a decision of that kind today and being able to go on losing money in that business for as long as ICI did. And actually, I think you're right that the change had occurred, well before ICI blew itself up in the 1990s. That by the 1980s, it would have been very difficult for ICI to have made that kind of judgment. The only market environment in which one can see that kind of judgment being made is one in which you have some supportive investors who are willing to accept that they're in this company forever and who will recognize that some of these very big long-term bets will fail in just the same way as a large proportion of private equity investments fail, but others will be sufficiently rewarding to pay for the failures.
But when you were citing earlier...
Here, if I may. Sorry.
When you were citing earlier the fact that these are now BASF and Siemens and we have no, effectively, the corollary was we have no British champions. I mean, not only was I thinking, well, that's a bit unfair to, Unilever and Experian, Diageo, Rolls-Royce. Now, Rolls-Royce was able to make a long-term decision, but it bankrupted them in the 70s and had to be bailed out. But as a consequence of that, they are now absolutely a world leader in their field and a true British champion, and they can make investment decisions because they've got the track record on a multi-year time frame. And I think the ICI, ultimately what became Zeneca and AstraZeneca, is almost an isolated example relative to, I can't think of dozens and dozens of other companies, even going back 40, 50 years, that would have been making those sorts of 20-year investments of perpetual losses and so on. I think it's a very particular example. And as I say, by contrast, there are actually a whole number of world-beating companies. I mean, if a Yorkshire designer can create Burberry handbags and charge £20,000, this country has a future. It's just...
Two questions, if I may. One is, If you were starting from scratch in this industry, going back 100 years, would investment management be paid for through an ad valorem rate, or would it be paid for with some form of flat fee and some reward for success? And the other one is, who monitors the monitors? In a sense that the consultant actuaries have been around for many, many years. Has anybody ever sat down and actually monitored what their advice has been over those years, and has it actually been good advice?
Could you please answer in no more than 45 seconds per question?
Who wants to take that?
Well, the first one on fees, I mean, it's fantastic for a business to have management fees that go up in line with markets. It's effectively a permanent price rise most years. But you can't pretend it's in the best interests of consumers, because your costs don't flex in anything like the same way as your management fees are. So it's a tremendous gravy train for the shelves of an asset management company, but it's pretty hard to justify.
And the best description of AIF MD that I've heard was that when the fight breaks out in the bar, you take advantage of the confusion to beat up the guy in the corner whom you never liked anyway.
This question comes from a former fund manager. You seem to, as a panel, all agree that there's too much humdrum active fund management. There's too much, not enough that you can find that's worth paying for in certain markets. But is there actually enough truly active short-term management? Is there a place for short-term management with an avowed goal of not making long-run bets in the way that private equity managers or quite a few successful active managers do, but instead want to be judged year by year by their results against the market? I find as a private investor it's very hard to identify any managers who hold themselves up as having the ability, or at least wanting to challenge themselves to outperform the market on a year-by-year basis.
Well, as I opened already, in terms of my style, my investment time horizon is 5 years plus. I have absolutely no ambition to try and outperform every year, because I think it would be impossible. But the fact that over 10, 11 years, despite some appalling years, I've managed to generate 10% per annum absolute, net of fees, dealing costs, charges, etc., against an index of about 6. I think that kind of suits what I'm trying to do. I think when I have seen very good long-only active managers start to either chase shorter-term performance because they're concerned about their job, their turnover goes through the roof and the performance usually deteriorates. Equally, very good long-only managers who've tried to become hedge fund managers and do the short side, it's very few that can do that successfully. You end up becoming effectively a day trader, and actually you may have been a good long-only manager, not a good day trader. So I'm the wrong person to ask, really.
I don't personally believe it, that you can do it. You can see it in the hedge fund industry, because they just blow up all the time. Normally, having paid 2 and 20 or whatever, they then blow up and having taken all the money anyway. So I'm afraid I don't believe it. I believe the better investors are long-term investors.
But the other thing I'd like to flip back on in terms of corporate behaviour, and again where I violently agree with John, we urged Unilever to move away from full quarterly reporting, because no business can be run sensibly for 90 days. And the danger with quarterly reporting is that it can induce a mindset where by the beginning of the third month of the quarter, if they're not quite making the numbers as expected by the market, they'll cut the R&D, or they'll boost the A&P, or do something to make the numbers. And sadly, in years gone by, Unilever was a company that would actually do that. They have now completely switched their focus. They are obliged by the listing requirements, but the K review recommended that was abolished. to provide a quarterly report, but they give a bare minimum of information in that quarterly report because it just induces the wrong behaviours within a company. And we would fully applaud. The only people who benefit from quarterly reporting are investment banks because it generates churn and turnover, and the pre-results note, the immediate flash note on the results, the post-results note, it's all churn, churn, churn. And again, a violent agreement with John that anything we can do to put grit in the flywheels of hyperactivity in the quoted sector and in investment banking and in gin rummy corporate portfolio management, the better.
Isn't the reality that we actually need people that have got both long-term horizons and short-term horizons, in the same way that different types of investors have different required rates of return? I mean, that's what makes a market. I mean, we're all very long-term. There isn't going to be much liquidity. I think what we're probably talking about is that there are too many people who are too short-term. But we do need some people to be short-term. We need traders. We need guys providing liquidity. The reality is we need a properly balanced market, not just a long-term market.
No, we're not trying to make a market. We're trying to provide better returns for savers in the long run, right? And I would never hire an investment manager who didn't underperform in 1999, because I know that investment manager who did outperform in 1999 style is one of momentum-based investing without regard to fundamental value. And there is firstly no public value in the existence of such managers, and there is in the long run no private value in the existence of such managers.
Would you tax time horizons differently?
No, I wouldn't, because I'm against fiddling with the tax system in that kind of way, which simply creates more distortions than it eliminates.
Okay, we've got time for one final question.
Professor Kay mentioned a long chain of intermediaries within the financial services industry. At least fund managers disclose the fees that they receive, whereas virtually every other participant within that chain either hides their fees or discloses them in the small print, particularly looking at the investment banking community as well as custodians and even regulators. What proportion of all the fees that are paid to the fund managers themselves?
I can't give you an answer to that question, unfortunately. I wish I could. And I do commend fund managers for having better disclosure than many of the intermediaries in the chain. But there's still quite a lot of improvement possible in that disclosure as well, in my view.
Well, if a mutual fund has a total expense ratio of 175 basis points, anywhere between 60 and 75 goes to the fund manager. Well, that's excluding frictional costs of trading, actually.
I think that brings us to a close. I'd like to thank the panelists for a very lively and interesting debate, and thank you for listening.